I can't help but begin with you on inflation. It's been 2 whole generations since the United States last wrestled with raging inflation. And of course, now prices are soaring again and financial markets seem increasingly uneasy. Are you worried about inflation?
I am worried about inflation. I mean, inflation is excessive inflation. Everybody wants a little inflation. And by the way, let's remember, Eric, for the last 20 years, every country in the world has been trying to get 2% inflation, and they haven't been able to do so. A little inflation is good. It keeps everything kind of moving. But excessive inflation, defined as much more than 2, is not desirable. And, in short, for the most part, higher inflation means higher interest rates. Higher interest means lower asset prices. And that's what's going on right now.
And higher interest rates could also throttle the economy. Do you feel like the post-pandemic recovery is now in question or at risk?
I don't think it's I mean, first of all, I proudly assert that I'm not an economist, but as you know, I think that we're going to continue to have a recovery, but I think that, with higher interest rates, all else being equal, it won't be what it otherwise would have been. Low interest rates are an incredible stimulant, and so the economy will be less stimulated.
Howard, when we spoke a few months ago, you described assets as being in a quote-unquote everything bubble, you may recall, and you urged the Federal Reserve to let interest rates normalize. What I want to know is this: should we want, do you want, does Oaktree want Jay Powell to use this opportunity with inflation staring us in the face to prick the everything bubble? Or maybe it's already been pricked.
I don't think that the Fed should try to manage asset prices, but I think that it should try to create an environment which is conducive to the economy doing its thing. But I also believe that other than at the extremes of overstimulation and hyperinflation or recession, I think that the Fed should be relatively passive. That's why I called for hands off and let's have naturally occurring interest rates. So look, interest rates I think have been artificially low. They were made very low to get us out of the pandemic lockdown of the economy. That certainly has served its purpose. The economy turned very strong, has been very strong, and that strength is the demand related to that strength is to some extent contributing to the inflation we have. I think that interest rates have to rise. The economy has to be less stimulated, but we're seeing that more interest rate increases sooner than the Fed had previously led people to believe. All of this will cool off the economy to some extent.
So here's the question: the Fed thinks it can be incrementalist, right, with these rate increases bit by bit by bit, but I don't need to tell you, because you've been around longer than me, soft landings are notoriously hard to achieve. What if the policymakers are wrong and beating this round of inflation requires something like Paul Volcker's Saturday Night Special of October 1980?
Well, first of all, let me respond to the second part of your question. We don't have inflation like Volcker faced. And Volcker came in and inflation was considerably higher than we have today, and it had been going on for 6, 7, 8 years. We don't have that condition today. So it's not going to take what Volcker did. I have a note on my wall at the office saying the rate on your loan is now 22 3/4. We don't need 22 3/4% interest rates. Look, the people. I assume that people only work at the Fed who believe that they can engineer changes in the economy, which they desire. You called it soft landing, and you have this knob, and you turn it a little bit at a time till you get the economy and rates to exactly where you want them. In my opinion, that overstates the ability of economists to act with precision. Uh, and so, it's hard to get exactly what they want. And the first interest rate increase may not cool off inflation very much, and the second one may do a little more, and the third one, but then the fourth one may impinge on growth. It's very, very hard, in my opinion, to get these things exactly right.
Howard, since you were actually managing money back in 1979 and 1980 at the time for Citibank, and your co-chairman Bruce Karsh is a similarly experienced investor, what is the Oaktree view on how to invest in inflationary times?
Well, I think that if you think you're going to be living in inflationary times, you should have things which will do. You should have some things in your portfolio which will do well under that scenario. So, number one, you might want to have more floating rate debt than fixed rate debt, because fixed rate debt goes down when rates go up. You may want to have more properties that you can rent out and where you have the ability to increase rents over time. Companies that grow fast enough to outpace inflation. These are the traditional ways to deal with inflation. That's number one. Number two, I would not, as I said in a recent memo, I would not invert my portfolio. I would not throw out everything I own and buy a bunch of what I just described. That's going too far. And what if you're wrong? And what if inflation cools off naturally? 8 months ago, Jay Powell thought inflation was going to be transitory. What if it turns out now maybe doesn't think so, but what if he turns out he was right then? So you just do little changes at the margin, in my opinion. Oaktree is not a macro investor. Our investment decisions are not directed by macro forecasting. Because it's so tough to get it right. And so, I think buying good assets at attractive prices for the long term is still the best tool in any investment scenario.
But if the Fed, to take the other point of view, if not it's a point of view possibility, if the Fed loses control of inflation and has to jack up interest rates, that does have implications for credit investments, certainly for fixed rate instruments.
It has implications for the prices of fixed rate investments. Remember that you buy a 5% bond, you put out $100, you get 5% interest a year. Interest rates go up, the price of the bond falls to 75. If you're right about the credit worthiness of the issuer, you get 100. You get your money back at the end. You get your $100 back. So when you're a credit investor, as we are, we used to call it fixed income. You shouldn't care that much about prices are going to go up or down, and so you should buy or sell. Returns in our area we have the great luxury that the returns in our area are contractual. The borrower takes your money, promises you interest, and promises your money back. Your return, in the ultimate sense, does not come from the market. It comes from your borrower and your contract with him. And people shouldn't get excited about buying and selling and getting out in time and then getting back in time, which is so hard. If they have entered into a credit contract with a good borrower, they're going to get the yield that they signed on for. And they should be happy with that.
I'm so glad you brought up buying and selling, Howard, because your latest memo is something of I might even call it a mini manifesto against selling, because there are, as you explain, many reasons not to sell at any point in time, many reasons. But the reason I'm bringing it up is because timing is, as they say, everything. And some people are going to read this memo, whether they should or shouldn't, as an exhortation not to sell, just as the stock market's off to its worst start since 2016. And is that what, I can't imagine that that's what you intended them to think.
No, I wanted to sell for the right reasons and not the wrong reasons. But most people, most individuals, and I dare say, Eric, most people listening to this program don't have the ability to time buys and sells. And for these people, when you mentioned timing, I thought you were going to the quote from Bill Miller, which I used in my in my memo, and Bill Miller is one of the great investors of our generation, and he said, it's time, not timing, that works as an investor. Time in the market. And getting in, getting out, hard to do. Being in over time is what makes people successful as investors. Now, a great professional may be able to add a bit to that by getting in, getting out, or overweighting this and now overweighting that. But very few people can do so successfully. I think most people trade too much, Eric.
Sure.
And most people trade to their own detriment.
Well,
and I mentioned the fact. Sorry, you want to say something?
No, I wanted to ask you about Oaktree. Oaktree is not a bunch of traders either,
right.
But you've traditionally made money by capitalizing on market panics and buying at distressed prices. And that, by definition, requires having to sell some things at some times in order to raise cash to deploy at opportune moments. And I'm wondering if that's where we are yet.
Well, I hate to say it, but your question's a bit fallacious, because what we have historically been able to do successfully is raise additional money in anticipation of buying opportunities. When we saw fundamental problems in the investment environment, that is, I'm not saying we foresaw a dip. When we see fundamental problems in the investment environment, historically, we have gone out and raised additional capital, which we were able to deploy when those problems arose, depressing asset prices.
I see, and that.
So we did not sell. A matter of fact, one of the tenets of our investment philosophy, of which there are 6, says that we are not market timers. We do not sell in advance of a coming dip, because it's so hard to get that right.